So the market is, well, for a lack of better term, doomed. So yeah, I'm not sure how am I gonna make this video either. I'm not sure if this is gonna be a fast video or a long video. But yesterday, basically, we have met up with one of the worst market, ending out the worst week since the pandemic even started. I've been reading a lot last night. I think I slept at about 7 or 8. Just reading up on stuff about the entire market and such. Let's start with some of the articles that I actually keyed out as the things that needs to be looked at. The tech heavy index fell 2.7% Friday and ended the week down 7.55%. So Nasdaq fell 7% in 1 week. S&P was down almost 6% in 1 week. And we are looking at this as the worst week since the pandemic. The panic since the panic was at its peak. And of course, we are also en route to have the worst month since financial crisis in 08. And yeah, I feel that because of this, the VIX is also going up, which is the volatility index. And just to give you guys a little bit of context, the VIX right now is at 28 points, almost 29 points. For a normal market, usually we look at 12 points or even 13 points. During pandemic, it went all the way to 32 points. Right now, we're at almost 29 points. So, yeah. So right now, the Fed over here, the Fed is saying, okay, zero interest rates don't make sense here, so we're going to move back towards something more reasonable. They're not really hikes, but signal that a big rate of change is coming. So this is actually a very, very big statement over here. They are not really hikes, but signal that a big rate of change is coming. All right, so first of all, for people who do not know, the FOMC meeting is going to be held on the 25th, which would most likely be a Tuesday, I would assume. Let me just check. On the 25th, yes, okay, it's going to be a Tuesday. The FOMC meeting is going to last. Is going to be held on the 25th and 26th, and we'll most probably get Jerome Powell talking on either the 26th or 27th about this entire issue. And chances are we are expecting a 25 basis point increase for the interest rates, but we're not expecting it to come in January because if, according to what Jerome Powell has been saying, we are not going to be increasing rates until the taper is completed. However, right now the issue is that we are afraid that even if the taper is not completed, first of all, there is a possibility that Jerome Powell is still going to be like, all right, you know what? In order for us to not destroy the market directly, let's start increasing rates even before we finish tapering, which is also a possibility. Okay, I'm not going to say that it's not a possibility. Next up, we have to take into consideration if he doesn't increase rates, if we don't go through a rate hike in January, that means in March, the FOMC meeting, we are assured to get a rate hike. And what's the worry there is that if we're not getting a 25%, no, 25. If we're not getting a 25 basis point, we're getting a 50 basis point increase, which is going to be a 0.5% increase instead. Then that's going to be the huge issue. And right now, that's kind of where we're at right now because of that. And what we're afraid of is like what I show you over here. This is what the strategists and analysts at Credit Suisse is saying. They're not really hikes, but signal that a big rate of change is coming. So we cannot really expect things to be just hikes. We cannot just expect 50 basis point every single time an FOMC drops, or even 25 basis point or 50 basis point, or even 100 basis point, whatever it is. I don't think that these are the kind of changes that we can be expecting in the near future anymore. There is a good chance that they will just be like, all right, we are going to 1% right now. Almost like how they're tapering. Just that they are going to be increasing rates way faster and way more aggressive. There is a very, very possible outlook that we're looking at. Okay, I wrote down some of the things that we are going to get destroyed by. So next up is going to be earnings seasons. Okay, I'm pretty sure I touched upon this on the earnings side of things. Earnings it's hard for earnings to really be to give us any sort of catalyst in the near term future. Because, for example, if you have a good earning report for any sort of company, they are going to just prove that it is that the market is kind of ready for this rate hike, and that's going to be bad. Because if they're ready, we're going to get destroyed. And if we do get bad earnings, on the other hand, that is also quite an issue, because if we get bad earning, it simply means that all of us are going to get destroyed because we missed on estimate, or because the forecast is different. The forecast is getting lower. Look at Netflix. Netflix alone lost 20% because of a bad forecast. And look at Amazon, down more than 5% intraday. Nike down. A lot of like the so-called stocks that are meant to really hold their own were all going down. And that was a big issue. Yeah. And let's also not forget, we have CPI coming up, which, let's be honest, I don't think this CPI is going to be any different from the December one. If we can hit 0.5, that would be great. If not, maybe 0.4, 0.3, I don't care. But I think, yeah, we have to take that into consideration as well. And afterwards, the last one, which would be, like what I said before, March FOMC. That is my biggest worry now. So yeah, I'm not sure what will happen in the market right now. Okay, I might sound a little bit down, because it's just that this entire week was very, very tough on my portfolio as well. But at the same time, because everything is down, you can't help it. Okay, you can't help it. But yeah, even crypto is down and such. Everything is down actually. So I'm just gonna be showing you guys some stuff that I've been looking into. So crypto crash eases more than $1 trillion of market value. That's quite crazy. Okay, actually, there was one Bloomberg article that was very, very interesting that I wanted to show you guys. Let me just check options. Yeah, okay. Okay, so this article is quite crazy. Options expiration of more than $3 trillion are helping stoke market turbulence in a week already defined by the route in stay-at-home stocks and gyration in bonds. So what happened is that we have a lot of options that expired yesterday. Okay, basically, the options market yesterday was very, very saturated. We had up to $3 trillion in the options market alone. And yeah, because of that, you can expect that more than half of them basically expire worthless. So when we say a lot of money is in the market, there's a lot of cheap money and such. It's easy for us to always see this kind of thing. But when this kind of options expire every single week, every single month, it gets harder and harder, and then money get decimated, evaporated from the entire market itself. So the Goldman Sachs actually estimated $3.3 trillion of US equity derivatives are set to expire Friday, which was yesterday. And $1.3 trillion across single stocks, $1 trillion in SPY, S&P 500 linked contracts, $240 billion in option tied to the world's largest ETF, which is SPY. Okay, yeah, definitely SPY. Yeah, so options are not the only driver of stock, of course. There is plenty of uncertainty around their influence, but they may have added to volatility as the likes of Netflix and Peloton slump on miserable outlooks while the rate-driven route tightened its grip on pricey growth stock. So the final issue that we have to also talk about, which is Netflix and Peloton. Why did just these two companies alone can kind of crash the market? First of all, for people who have not watched my previous video about Peloton, you do need to know that Peloton was this stay-at-home hero. Okay, when you are a stay-at-home stock and you are a hero, they went from $20 all the way to $120. It was crazy. Okay, they were labeled as the stay-at-home stock, alongside with your Zoom, alongside Netflix, of course. And because of that, after we see such a huge tumble down, of course, yesterday Netflix did do very well, 14% up, because the CEO actually came out to refute claims that they are actually halting production, but it's more so that they are shifting around what they are going to be doing and such. But of course, I'm still a little bit worried because that's kind of what a CEO is supposed to do, kind of put out a fire. So I feel that that's kind of understandable to a certain extent. But I feel that when the earnings do drop, if I'm not mistaken, it should drop on the 8th of February. We might see some crazy movement in Peloton nevertheless, which is why I'm still very wary about Peloton. And so Netflix, then suddenly having a change in their forecast, having lesser growth, lesser subscriber count, and just lesser revenue forecast in general. That's a very, very big issue because, like I said before, big market, it's a very, very saturated market as well. You know, the audience, basically everyone knows about your brand. It's just that, you know, it's hard for you to suddenly, your marketing money, more marketing money doesn't guarantee you more leads or more consumers to actually join your platform. That's the issue. And because Netflix and Peloton, these two have such bad news. Basically, anything that has to do with stock, okay, it doesn't matter if you are a social media, company, be it you are a Twitter, you are a Snapchat, you are a Meta platform, your Pinterest. We don't care. You're gonna get destroyed. And because of all this, not only just your social media, your tech company, Palantir is gonna get destroyed. SoFi is gonna get destroyed. Roblox gonna get destroyed. EV company wasn't really spared either. Actually, EV company, I'm gonna actually leave it for another video because EV companies actually got destroyed so badly that I think, if I'm not mistaken, Tesla was down 5%. Yeah, Tesla was down 5%. Tesla is already below the $1,000 mark as it is, and if I'm not, I think they might even be out of the $1 trillion cap. They are. Tesla is out of the $1 trillion cap. So, yeah, of course, we no. Okay, I would say no one was expecting it. Of course, a lot of people were calling bear market left and right. I would say that this is a bear market. I don't think that we are going into a recession yet. Okay, I don't think we're going into a recession yet. But I feel that a recession can easily happen. And right now, all eyes are basically on Jerome Powell. all eyes are on Jerome Powell, all eyes are on the Feds, all eyes are going to be on the next few FOMC and the next few CPI, most likely. We need to see either disinflation, and of course that's for us to actually see in the long run, for us to look at maybe 0.2, 0.3% inflation CPI for us to really be comfortable with the market. FOMC, if they do continue with their economic projection showing us that 2022 is still going to be about 2.5, 2.6%. Highly doubt it, but I wouldn't mind some coddling by the FOMC right now. And of course, even their dot plot, if they do show that there is a huge spike to having 4 rate hikes or even 5 rate hikes, that's going to destroy the market. So yeah, I think Wednesday and Thursday of next week, we'll see some volatility in the market. If the FOMC meeting comes out to be something that we can actually be happy about, for example, there's going to be volatility because people are going to be buying the dip. Okay, people are going to be buying back into the companies that they like. People are going to be buying on the fact that there's going to be a brighter future ahead. However, if we do get Jerome Powell coming out being hawkish, saying that, all right, we might not even have to finish this taper, but we have to raise the rates. This is going to be very, very dangerous for us. We have to start doing this, we have to start doing that. Okay, and because that, there might be volatility in the market again, because if everything do crash, okay, and I do say crash, then yeah, there's not enough of buying the dip for people to really come. Right now, honestly, the only reason I feel that we are still sustaining the current market that we have right now is also because there's a lot of algorithm traders where they do not care about emotions. Basically, because you hit this basis line, we're going to buy. You hit this basis line, we're going to buy. If you go up 10% of this basis line, we're going to sell. We're going to just make profit every single time we hit 10%. That sort of algorithm traders. In this market right now, 60% of the trades that are being published or being executed right now are all done by algorithm traders. So it could be bots, it could be just an AI, it could be someone following this method of trading, but chances are 60% of them are actually being done by algorithm traders. So even if we are going through this recession, we are basically being sustained by all these algorithm traders. They are the ones that are like, Tesla at 900, yes, let's buy it. That kind of thing. Of course, for Tesla, it's going to be a different case because Tesla do have a lot of their supporters, people who are bulls on Tesla, seeing how Tesla can go to higher heights in this year or even next year. So, yeah, I do not want to be a bear to say that we are going into a recession. I really don't. But even Elon Musk is also calling a recession in the near future as well. But yeah, I mean, I don't know what will actually happen. Right now, basically, I'm just making this video simply because I am still a little bit confused of what I want to be talking about in the market and like how the market is usually behaving right now. And yeah, I mean, I'm sorry for people. I was actually gonna be doing the crypto video. I really was. I actually have finished doing the research for it already. So I will make sure I can post the video on the top 5, the 5 cryptocurrency that I'm going to be holding in 2022 on Wednesday instead. It's just that I felt that today this video is a lot more important for me to actually get it out because we are going through a few so-called bear catalysts or even fear catalysts in the near future. And by the near future, I mean in the next 3 to 5 days. And I think that this should come out first. But okay, anyway, I'm just gonna let you guys see like a few more stuff, like Shopify tumbles on report of it terminating fulfillment contracts. VIX, going up to peak panic. Okay. Fed seen signaling March rate rise, asset runoff soon after. So for this one, like what I said before, 3 was basically what the previous FOMC dot plot was actually expecting of us. Right now, people are treating it as 4. Some people even treat it as 8, which is kind of crazy. Tech earning jitters mount as a pandemic darling get crushed. Don't get me wrong, I'm not unhappy about the fact that stay-at-home plays are getting destroyed, because at the macro perspective, it's a good thing, because if that happens, basically it means that we are getting out of the pandemic. Okay, in the huge scale of things, it's a good thing that we are all this stay-at-home play are getting destroyed. So completely fine with that. Okay, real interest rates are rising here for stock that can still thrive. I thought that this was quite interesting because they were talking about Walgreens. I thought Walgreens is a good play on recovery, and also a little bit on dividends as well. And also Beatrice. So Beatrice is basically just a drug maker, and they did have pretty good earnings. Of course, do your own research if you are interested in all these kind of stocks. Just go and study up on them a little bit. Peloton Tough Spot is now both the Netflix and Dell of fitness. Yikes. I mean, still is. Okay, Foley, which is the CEO of Peloton, we feel good about right-sizing our production. And as we evolve to a more seasonal demand curve, we are resetting our production levels for sustainable growth. The CEO cited a pre-earnings quiet period for not sharing details sooner. Chances are the CEO also knows that if he were to start offloading his shares, we expect earnings to be horrible. Okay, so the latter doesn't really change the difficult spot that Peloton is in. Once upon a time, the company was known as the Netflix of fitness. Yeah, that's what I'm saying. There is a chance that you guys do not know who Peloton is, what Peloton does. But Peloton was once the Netflix of fitness, which is why, because of the and I can see why this kind of works out as well, because with Netflix subscriber kind of dwindling down as well, we can see why it's also the Netflix of fitness. People are just kind of worried as well. But yeah, Peloton has the negatives of Netflix. Okay, high cost to create content without the benefits that come from an asset-light business. So Peloton right now, there is a good chance that in the next earning video, in the next earning report, we see Peloton having billions of dollars in inventory, because they just have been chugging out so many bikes with no demand. There is a possibility for us to actually see that. And because of that, this is by no means asset light. For Netflix themselves, on the other hand, basically what they're doing is they're just either funding new productions or getting into new projects. Basically, none of them are. They have a high cash burn, but like what they say is asset light. So Netflix, on the other hand, that's one of their biggest boon, which is why I feel that Netflix in the long run is still going to be a good company. But Peloton, on the other hand, though, let's just say I bought a lot of puts on Peloton as well now, even though I have shares in it. Okay. So yeah, like Dell and other hardware firms, Peloton business is reliant on making costly goods and shipping them quickly to customers. So take this into consideration, because Peloton at one point of time, in order for you to buy a bike and have it delivered to your house, it was about 4 weeks to even 6 weeks, because of supply chain issues, because of labor shortages. Right now, if you were to order a Peloton bike, of course, this is all for the US, not for Singapore or anything. Right now, if you were to buy a Peloton bike, you can actually get it the day after. That's how bad it is. They are literally having like 6 models of bike prepared. Okay, you want what bike? Okay, yeah, we got it. We're gonna deliver it to you tomorrow. That kind of thing. And yeah, if demand do cool down, all these bikes and treadmills basically become dead weight to the entire company, and that's kind of what Peloton is going to go through right now. And I don't want to really harp on Peloton too much, but basically what Peloton is doing right now with this entire scenario happening around Peloton is creating more of a conscious situation for all the other companies that we are all talking about. Any other company, any other tech company who get into hardware will see a problem that what Peloton is going through, the Peloton's dilemma. Other companies who are doing hardware will see the same issue. And that's why people are really getting a little bit cold feet after looking at the whole Peloton halting of the entire production. But yeah, you know what? Sad news and such. But anyway, I have to head to the gym soon. So I'll see you guys in a bit.